Welcome to our deep dive on the 529 tax trap, focused on the grandparent reimbursement myth. In this video, we will clarify what reimbursements are allowed, how timing affects taxes and penalties, and which payment method to use to avoid costly mistakes. We will also provide practical steps, visual diagrams, and quizzes to help you retain the essentials. Let's begin by previewing what you will learn today. Then we will set a quick disclaimer so you know how to apply this information. Here is our roadmap for today. First, we will define the reimbursement myth and what is actually allowed under federal rules. Next, we will compare the three common payment methods: paying the school directly, reimbursing the account owner, and paying the beneficiary. After that, we will dissect the critical calendar year timing rule that often causes distributions to become non-qualified. Then, we will cover what documentation to keep and for how long. Throughout, we will use diagrams and a couple of short quizzes. And finally, we will wrap up with an action plan you can follow immediately. Before we proceed, a quick disclaimer. This content is educational and should not be considered tax, legal, or financial advice. Your personal situation and your specific 529 plan rules may differ. Always review your plan documents and consult a qualified professional before making withdrawal decisions. With that noted, let's move into why this topic matters so much. The reason this topic matters is that 529 plans offer significant tax advantages when used correctly. However, a small mistake, like taking a distribution in a different calendar year than when the expense was actually paid, can convert tax-free earnings into taxable income and potentially add penalties. The goal is to protect your savings by aligning the payment method and timing with both IRS rules and your plan's specific procedures. Next, we will cover the basics of 529 plans for context. Let's start with the 529 plan basics. The purpose of a 529 plan is to provide tax advantage savings for qualified education expenses such as tuition, fees, books, and often room and board if the student is at least half-time. The main parties are the account owner, who controls the account, the beneficiary, who is the student, and the plan administrator, which is the state-sponsored plan provider. The core tax benefit is that earnings grow tax-deferred and are tax-free if used for qualified education expenses. The account owner retains control over withdrawals and can sometimes change the beneficiary within family limits. With the basics covered, we can now address the reimbursement myth and the payment method choices. Here is the crux of the so-called reimbursement myth. Under federal rules, reimbursement is generally allowed. The 529 account owner can withdraw funds to reimburse themselves for qualified education expenses already paid. However, there is a crucial caveat. You must keep thorough documentation, receipts, invoices, and proof of payment that clearly show the expenses were qualified. Additionally, plan-specific rules vary. Some state plans prefer or even require direct payment to the educational institution. It is essential to confirm your plan's permitted withdrawal channels: direct pay to the school, reimbursement to the owner, or payment to the beneficiary before choosing a method. Now that you see the options, let's compare them side by side. Let's compare methods directly. Paying the institution typically minimizes timing risks and often aligns with plan preferences, which reduces the chance that the plan will flag your withdrawal. It also tends to reduce documentation disputes because funds travel directly to the school. In contrast, reimbursing the owner or paying the beneficiary offers flexibility for cash flow, but it requires impeccable documentation and introduces greater risk of a timing mismatch between when the expense was paid and when the distribution occurred. Next, we will examine the calendar year timing rule that creates the most common and costly errors. This is the most common trap. The IRS focuses on when the expense was paid, not when it was billed. To qualify for tax-free treatment, the 529 distribution must occur in the same calendar year that the corresponding qualified expense was actually paid. For example, if tuition is paid on December 15th of 2025, the distribution should be completed by the end of December 2025. A distribution in early January 2026 would be a mismatch. Such a mismatch could cause the earnings portion of the distribution to be taxable and possibly subject to penalties. With that timing rule in mind, let's visualize the full semester cash flow rhythm. This Gantt-style diagram shows the typical semester cash flow. First, the school issues the tuition bill, Then payment is made by the family or via a direct plan payment. Books and supplies are often purchased shortly after classes begin, and housing is billed and paid on a schedule. The key takeaway is that the distribution window from the 529 plan must match the calendar year of the actual payments. If a payment occurs in December, the related distribution should be completed before the end of that same calendar year. This alignment prevents the timing mismatch that can lead to taxes and penalties. Next, we'll offer a quick reference table of what typically counts as qualified expenses. This table provides a quick reference. Tuition and mandatory fees are generally qualified. Required books and course supplies are typically qualified as well. Room and board can qualify if the student is at least half-time, but there are limits tied to the school's cost of attendance figures. Computers and internet access can be qualified if they are used primarily by the beneficiary during enrollment. Transportation costs, insurance, medical expenses, and late fees generally do not qualify. Always verify with your plan documents and IRS guidance. With the basics and rules clear, let's move into a step-by-step process to reimburse safely. Follow these steps to reduce risk. First, confirm your plan's allowed withdrawal channels, such as direct-to-school, reimbursement to owner, or payment to the beneficiary. Second, ensure the distribution occurs in the same calendar year as the payment. Third, collect proof immediately, including receipts, bursar statements, and bank or card confirmations. Fourth, maintain a distribution log that records who paid, the amount, the purpose, and where the supporting documents are stored. Fifth, if uncertainty arises, consider paying the institution directly to avoid reimbursement timing pitfalls. Finally, reconcile at year-end to make sure each distribution matches a qualified expense paid in that year. Now let's test your understanding with a quick quiz. Quiz time. Which date matters most to the IRS when matching a 529 distribution to an expense? Option A, the date the bill was issued by the school. Option B, the date the payment was made for the expense. Option C, the date the student registered for classes. Option D, the date the refund deadline ends. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is the date the payment was made for the expense. The IRS focuses on the payment date, and the distribution must occur in the same calendar year as that payment to be considered qualified. Second quiz. Which withdrawal method typically reduces timing risk the most? Option A, reimbursement to the account owner. Option B, payment to the beneficiary. Option C, direct payment to the school. Option D, waiting until the next calendar year to withdraw. You may pause the video now to consider your choice. We will discuss the answer in the next section of the video. The correct answer is direct payment to the school. This method often aligns with plan preferences and minimizes the risk of a mismatch between the payment date and the distribution date. Let's solidify this with a quick case study. A parent pays $12,000 of tuition on December 15, 2025. The account owner requests a matching distribution on December 29, 2025. However, the distribution does not process until January 3, 2026. This creates a timing mismatch because the payment occurred in 2025, but the distribution posted in 2026. A better approach would be to initiate and complete the distribution before the end of December 2025, or to have paid the school directly earlier in December to eliminate the reimbursement timing risk. With the example in mind, let's build a documentation checklist. Here is a practical documentation checklist. Keep bursar statements and invoices, proof of payment such as bank or credit card statements or canceled checks, and receipts for books, required software, and equipment. Include housing contracts if you plan to claim room and board. Save the distribution confirmations from the 529 plan. Finally, maintain a simple log that links each distribution to a qualified expense paid in the same calendar year. This paper trail is your best defense if questions arise. Now, let's distill the main takeaways. These are the key takeaways. First, reimbursement is generally allowed but requires meticulous documentation. Second, always match the distribution year to the actual payment year. Third, consider paying the school directly to minimize timing risk. Fourth, confirm your plan's permitted withdrawal methods because plan rules vary. Fifth, maintain a distribution log and reconcile at year-end to ensure each distribution is properly matched to a qualified expense. Here is your action plan. Review your 529 plan's withdrawal options and any plan-specific mandates. Set calendar reminders for tuition due dates and year-end processing deadlines. If you are unsure, consider direct-to-school payments to avoid timing issues. Create a centralized folder for documents and maintain a distribution log. Finally, verify that an expense is qualified before spending or withdrawing. This proactive approach helps preserve the tax benefits of your 529 savings. Thank you for watching. If you found this helpful, please like the video, share it with someone planning for college expenses, and subscribe for more practical financial guides. We would love to hear your questions and experiences with 529 plans in the comments.